Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW SYS008 traders. The title of the video is Know Why There is Equality Between the First and the Fifth Elliott Wave. Alright? Why do we have equality? Which means why the first wave is often equal to the fifth wave. Why there is equality between the first and the fifth wave. Now, what I've said now, we are not saying that it is always the case, but very often, all right, according to the wave theory, the wave principle, there is often equality between the first Elliott wave and the fifth Elliott wave. And the purpose of this video is to explain to traders why very often we have this equality. What we do care about is to increase the understanding of traders. It is one thing to know the wave theory. Everybody can open a book, learn, and memorize, okay, a subject. But it is another thing to understand and apply or master the subject. So what we are trying to do here is to give, okay, the understanding to traders. When a trader starts asking questions like this, why? It means that he or she wants to increase, okay, his or her understanding. All right. So why? Okay, it's a very beautiful question you should ask. When you start asking question why, you want to master the subject. Why MACD? Okay, crosses a bull signal line is bullish. Why when the slow stochastic is oversold is bullish? Why? Then you're going to go deeper and deeper, and you will be able to filter out false signal, useless setup, and start seeing clearly, not only seeing things, by looking inside the price, okay? Now, when we come to wave count, I always say to traders, feel free to disagree with me, because there is a lot of discussion on the, in the trading community when it comes to wave count, and traders love to disagree with other wave count. What I usually say is my wave count, okay? So look at your own wave count. Feel free to disagree with my wave count because I will trade it myself, okay? All right, let's move on. I have counted some wave here looking at the monthly chart of Home Depot. Home Depot is American stock listed on the Dow 30. I'll be coming back to this stock and I will be recording another video going deeper. What I will say to traders that are trading stock at this point in time is that Home Depot will find it a bit difficult to go over the level of 100. That's all I will say here. But stay tuned. I will be recording another videos very soon when I will go deeper into this wave count here on the monthly chart for Home Depot, Epic Hotel Delta. Okay, so my wave count is that you see the turquoise line here. 1, 2, 3, 4, 5 wave. Okay, the turquoise 5 wave formed the first Elliott wave. It is a complex first wave that is divided into 5 mono wave. It is an impulsive wave. An impulsive wave can be divided into 5 sub wave or 5 mono wave. All right. So this is the first Elliott wave from here to here. As I explained to traders, feel free to disagree with me. Now, when we count an impulsive wave, we want to make sure that we are not violating, the Elliott wave rule. The third Elliott wave should not be the shortest wave, and the fourth wave should not overlap the first wave. As you can see here, the fourth wave nearly go into the range of the first wave, but it did stop on top of it. So it's not too bad. You'll see that sometimes. Even you'll see that sometimes the price will deal into the range, but will close above it. All right. So this is it. So my wave count stand with the Elliott wave rules. This is an impulsive wave formed of the 5 mono wave. And from here, where I draw my 2 vertical lines, this is the first Elliott wave. followed by the second Elliott wave, which is a normal straightforward second wave right here for the Home Depot. So this is the second wave that I labeled in pink right here. Then I label the third, which is the longest wave in this case, which is I label it in orange here. This is my third Elliott wave on this monthly chart, followed by the fourth Elliott wave. As you can see, the characteristic of the fourth Elliott wave very often is very, very shallow because the bullish momentum is quite very, very strong. So there is no urge to sell as such. The market is dominated by the bulls, so it's usually shallow. We expect it to be shallow. So we will be a little bit suspicious if we have a deep fourth wave. That's why the rule stated that the fourth Elliott wave should not overlap the first wave. Watch the video at 2-4 Elliott wave why the fourth wave should not overlap the first wave. Now we are talking about the equality between the first wave and the fifth wave, focusing on the understanding, not the knowledge. No, it's not about no, it's about understanding. So this is my third Elliott wave, followed by my fourth wave that has, hold on please, let's move this to the side for a while, and we'll come back to that, So this is my fourth wave, followed by the fifth wave. Now at this point in time, so looking at this monthly chart, that's all I can say, But once we count the wave on one time frame like the monthly chart, we shouldn't stop on the monthly chart. Now we should validate our wave count going to the higher time frame. I've already done it on the yearly chart. I will come back to it. That's what I say to you. I'll come back to it. An impulsive wave on one time frame can be a minor wave of a bigger cycle. So on the yearly chart, we can say this is the first wave, second wave. You are now in the third wave in the bigger cycle for Home Depot on the yearly chart. But this is something else. I'll come back to that. So let's go back to our main subject. What do we show traders at 2-4 Elliott wave? We have a specific, simple guidelines that we try to simplify the wave counter. They asked me, by the way, I received one email recently from a trader that was telling me that he got a trick that he used, it's about looking at the longest wave first and then labeling the third wave, and then from there find the other wave. It's excellent strategy. So if you are one of the traders that contact me talking about this strategy of highlighting first the longest and then finding out what has happened around that longest, labeling the longest wave, the third wave, it's a great strategy, It's a great strategy. You can do that, But the guideline that I will share with traders is that very often, the first wave will come out of a consolidation. So when we're going to count wave, we are looking for a consolidation. So this is our first point. We're looking for consolidation, breakout, pullback, and then the third Elliott wave is the easiest wave one can label. It's also the most profitable one, which is gorgeous. It's easiest to find the third Elliott wave. It's also the most profitable one. But we want to look for consolidation, breakout, pullback without the second wave canceling the first wave. So this is our guidelines. Consolidation, breakout, pullback like this. Without the second wave canceling the first wave. If the second wave cancels the first wave, we must recount the full wave. Start afresh. This is the guideline. But there is another method that we can use apart from the consolidation, breakout, pullback, is that a cycle, an Elliott wave cycle, is completed. So what do I mean by that? We see multi-wave, which is formed of the first, second, third, and fourth, and fifth wave. The multi-wave is formed of the first, second, third, fourth, and fifth wave. That's the multi-wave. So the Elliott wave cycle is formed of the multi-wave plus the correction phase. So from here, where my cursor is, to here, this is what we call the multi-wave, followed by the correction in the form of ABC. 1, 2, 3. So from this point, from the beginning here, up to the end right here, this is an Elliott wave cycle. But sometimes trader will miss the second move because they are looking for consolidation. Sometimes after an Elliott wave cycle, a new cycle will begin. So if you see 1, 2, 3, 4, 5 plus ABC, ABC bringing the price into the zone of 50% and 61.8% of the motive wave, we are likely to see another first wave beginning from here. That's all I want you to remember here. All right. So Elliott wave cycle is completed. We may see straight away another cycle beginning, or at this point in time, once the correction is completed, we may see another consolidation again before breakout, pullback again, and so on. So be aware of the end of the Elliott wave cycle and the beginning of a new cycle. Sometime, some financial instrument will finish a cycle and will stay in the consolidation phase for many years, which means we will have what we call complex corrective wave, which we will not have straight away cycle, a new cycle, but we will have many corrections. This is about the complex corrective waves. So do not assume, that's what I say to trade, do not assume that at the end of an Elliott wave cycle, a new cycle will definitely start. Let's go back to the subject. So what is the roots of, an Elliott wave cycle? Now, it is very important for us to understand the root of a trend or the root of a cycle or the root of an Elliott wave cycle, okay? This is why there's usually equality between the first wave and the fifth wave. Remember this. Remember this. If you forget everything else, during the consolidation phase, all right, the first buyers or the core buyers, the smart money, will continue to buy. This is what we call accumulation. So they are buying during the consolidation phase, gradually, steadily, loading in, hedge fund, banks, big institution, pension fund, mutual fund. They are buying because they check the fundamental of Google Finance and Yahoo Finance. They know that the stock is undervalued, but they are gaining more market share. The sector is about to boom. They are the first buyers. They know that a cycle is likely to begin. The policy by the Federal Reserve, it will support, the commodity market, as we have seen recently, or will affect the commodity market one way or another. So they are the first buyers at the beginning of a bullish cycle, and they are the first sellers at the beginning of a bearish cycle. This is very important for us if you want to understand why there is equality between the first and the fifth wave. These first buyers that are buying during the accumulation period or that are selling during the distribution period, if you are talking about bearish cycle, all right, they are the same people that will close the trend. Why? Why? These are the core buyers, If these core buyers pull out of the market, there will be no trend. Sometimes you will see, that's why very often you see that when the second wave cancels the first wave, is signaling to us that the first buyers, the core buyers, the small money pull out of the trend. They have discovered something new, or the market sentiment has changed, and they pull out of the market, and the second wave will cancel the first wave. So we must restart counting the wave. Forget about the first and the second wave, because the second wave has canceled the first wave. We restart counting the wave altogether. All right? So these first buyers, the small money that are accumulating at the beginning of the bullish trend, or that are distributing the stock or the financial securities at the beginning of a downtrend, if they stay in the market, we are likely to see a trend. They are the root, all right, as I like to put it to trade, the root of the trend. All right, it's all based on the fundamental. It's all based on real people investing in the financial market. All right. So because this market participants are the first buyers, that's why we say to traders that the first wave should break resistance on the left-hand side. This is the signature of the bull. So we analyze the internal wave of the first wave. This will allow us to predict what is likely to happen in the whole motive wave, because it is the signature of these market, the first buyers or the core buyers. So with the first wave and the second wave, we can know straight away what is likely to happen. Now, remember what I said to you. So these are the first people that know that, we should buy Nike stock, we should buy Home Depot stock, we should buy Euro USD during the consolidation phase. And then everybody else suddenly see the first wave and then the second wave that did not cancel the first wave. So now the general public is aware that, look, the small money, in fact, was busy, buying this commodity, buying this security, buying this financial instrument, buying this stock, buying this currency pair. So everybody knows that now a trend is about to begin, because the third wave is underway after the first and the second wave. But the root of the trend, in fact, is hidden, all right, in the first and the second wave. There are more to that, but I want you to stay with me. If you do not understand my accent, okay, what you need to do, all right, watch it 100 times, okay? And you get used to my accent, okay? I have traded, I get used to my accent, okay? All right? So these first buyers, okay, are what I like to call the root. You see a tree, when we have a tree in the bush, all right? If you cut the root of the tree, all right, slowly but gradually, that tree will wither completely, will dry up, okay? So we want this core buyer, this first buyer, the small money that was accumulating, okay, during the consolidation phase, all right, to stay in the trend, all right? So because they represent the root of the trend. If they come out, the whole trend will collapse, which that's why we don't want the second wave. The first indication to us that the first buyer came out of the market is that the second wave will cancel the first wave. Then we know that they are no more in the market. So we want to see where they are, what they want to do. Are they following us? What's happening next? So the same people that have started the trend, their signatures, the first wave, all right? Their first measuring stick is the first wave. What do I mean by that? Okay, so suppose you are in any time, on any time frame. Remember what I'm going to say now, okay? Every time frame, you see a first move like this, okay? First move like this, okay? And then you see a pullback that did not cancel the first move. Any time frame, hourly chart, 4-hour chart, take it from me. It's just the language of the price, okay? If the price start going up from here, all right, the first challenge for the price to be completely bullish is this resistance here. Are you with me? So as long as we stay below this resistance, the price is not going anywhere. So as soon as the price goes above this high here, we will expect, repeat, expect the price to achieve minimum the previous length. So this is the bullish signature. So some people were buying like this. Now they pull back, a price start going up. But if it goes above the high here, the minimum target that we were expecting is the previous move. All right, so we'll go like this and set target like this and say we are expecting this stock, okay, to come into this region minimum. All right, if for one reason or another the financial instrument, after going above, okay, this high here, this powerful stuff I'm sharing with you now to understand the language, if it goes above this high here but fail to reach this target level, it is bearish. So suppose it did something like this, and then it just stopped there, and the common central line here is kaput, to speak a bit of German to you, and the price start going down. It's very bearish because we did not achieve the previous bullish move that it is our, okay, measuring stick. I hope you get this, all right? I hope you understand this, all right? Because it's so powerful. Any time frame, same thing. In a downtrend, price goes down like this, okay? And then a bit of rally that did not cancel the previous move, all right? Remember, and it start going down. The first challenge is what? This one here. This support here. If it doesn't go below the support, we're going to have a double bottom or a higher low, so it's not bearish. But once it goes below this support, we want it to achieve the minimum target, this one here. So we will draw a line there and say minimum that it should go below, so it should achieve this length, and if beyond it, to confirm the strength of the bearish momentum. So we will set our target here. But if for one reason or another it failed to achieve that target, it is bullish to a certain degree until we go back above this support level. So if it doesn't come all the way here, and we will wait for it, we can be patient and know that it's not very strong. But if you go back again this support, game on. We will look for opportunity to buy above here using the trading rail. Okay? I'm saying this for new trader, set up, signal, low risk entry point. All right? It makes sense? It is also powerful, okay? So we are talking about why the first wave is usually equal to the fifth wave. So remember, as the first wave is completed, as I counted here, you see my first wave 1, 2, 3, 4, 5. This is a complex first wave. I will measure the height of my first wave, which means the price goes up from this level here, where my cursor is, up to this level here during the first wave. So we want during the fifth wave, usually we will see that the price will achieve the same magnitude going from, if it's, suppose this is $100 move from here to here. I'm just talking roughly. Okay, I can roughly will say $20 move because level of 20 to level of 40. That's what we achieved during the first wave. So in the fifth wave, we will expect again, okay, very often you'll see that they will achieve exactly $20 move. Equality. So sometimes you will see some traders, as I explained to traders, they will measure the length of the first wave, which means from the beginning like this to the end like this. Sometimes you will see that equality like this, which means the length of the first wave will be equal to the length of the fifth wave. Sometimes it's not the length, it's the magnitude of the price progression. If we have $20 price move, we are likely to see $20 price move. I advise traders to concentrate more on the dollar move, okay? How much money, okay, how much profit was achieved during the first wave instead of the length of the first wave. But do not forget also that sometimes we see the equality that is reflected in the form of the length of the first wave being equal to the length of, the fifth wave. But I want traders to pay attention to the amount of profit that was achieved during the first wave to be equal to the amount of profit that will be achieved in the fifth wave. All right. So this is my first wave. I'm concentrating this time because the length of the first wave here is longer than the length of the fifth wave that we are now. So I'm concentrating on the amount of profit that was achieved during the first wave. I'll call it roughly $20 profit. Okay, $20 profits. Okay. All right. Talking about $20 profit. What do I mean by that? I mean 2,000 pips. Okay, $20 profit. I mean 2,000 pips. All right, all right. So once you can see here the way I label, I'm going to move my vertical line to the side bits. Okay, remember I put this here as my fourth wave. Okay, suppose now we see here, we see that we have a bit complex fourth wave. 1, 2, 3. All right, it went down here. If I use my measuring stick of the first wave, paying attention to the wave principle that stated that there is a high chance, not always, that there is equality between the first wave and the fifth wave, I will be positioning my measuring stick here. So then I will set a target for myself that, okay, we watch this zone. If I put it correctly, you can see that as the price, you can see how the price ran fast here. Boom, in 1 month, they push it here, and the small money took profit here. Did you see here? Can you see it? The equality here. All right? And people took profit here. Now, it doesn't mean that the price will definitely stop as soon as they achieve the equality between the first and the fifth wave. The price sometimes will go and exceed, okay, the magnitude of the first wave if the fundamentals are very strong and the market environment viable or the market sentiment is very, very bullish. The opposite is also true in a downtrend. Okay? It makes sense? So because the first buyers, the smart money, the hedge fund, okay, the big institutions that were buying during the accumulation phase or the consolidation phase are the first buyers. Their signature is the first wave. So what has happened, in fact, is that these people that bought it during the first wave remembered, okay, the amount of profit they have achieved during the first wave. So they decided they have it like this. Remember what I explained to you just now? So after the second wave, they set their minimum target like this using the magnitude or the length of the first wave like this, okay? Either amount of profit or the length. Here I'm using the length, okay? So they will use the length of the first wave like this, and they will position it here and say the minimum target is somewhere here, okay? And then during the third Elliott wave, if there are more buyers, the general public join now the first buyers, the price continue to go up, and we have a very long third Elliott wave. But remember, during every time the price pull back, they will use the first measuring stick, which is the first wave. So now after the third Elliott wave, the small money or the first buyer or the core buyers, okay, now were in fact the root of the whole trend, okay, they have achieved their profit during the third Elliott wave, because now they know that, okay, the minimum that they should achieve is the length or the magnitude of the first wave after the second wave. But because other market participants has now seen that, okay, there is a trend in place, more buyers joining them, pushing the price into the zone of 214 Fibonacci extension zone, 314 Fibonacci extension zone, they have achieved their profit. And looking back again to the fundamentals that these market participants have been using, they have noticed that now the asset is now becoming a little bit overbought or too expensive, okay, in their view. Now they don't want to buy it so much. But as the price pull back after the fourth Elliott wave, this smart money will use again the magnitude of the first wave as their measuring stick after the fourth wave, and we put it right there and waiting to achieve similar profit as the first wave. But as they realize that the market or the financial instrument or the security is now well above its fair value or its true value, they are divesting, which means they start again what we call, okay, consolidation, or they will start what we call distribution or a profit taking phase, which will form the corrective wave A, B, C. But as you see, as it was at the beginning, so it shall be at the end. You will hear that very often. The small money, this is their signature, this is their measuring stick. After the second wave, they will use it. But because more buyers join them, the third wave has been extended. Okay. After we see the fourth wave, they will use the same measuring stick. And once that level is achieved, they are very rigorous. If the financial instrument is too expensive or overbought, talking about the fair value or the true value, looking at the fundamental or the market environment at that point, the smart money will start selling. In fact, what usually takes place during that fifth wave, the smart money starts selling already. This is what we call distribution that will form the ABC pattern. All right, but the key point to understand why there is equality between okay the first and the fifth wave is that the core buyer or the first buyers will that have started the trend or the cycle itself will also end the trend. So they have started with the first wave, they will end it with the fifth wave. Now they know how they have started it. This is their measuring stick. They will use the same measuring stick during the fifth wave. Sometimes you will see that the fifth wave will be extended. Well, there are different reasons for it. If, according to the book, the stock still got value, or the equilibrium price level, this is a different matter, of the financial instrument is increasing, which means they have created more value, they are worth more than they were before, a new fair value is established, which is well above the end of the conservative target level for the fifth wave. The stock will continue to go up because the market is always looking ahead. So we may see a kind of extension to reach a resistance level or a fair value, okay, or the market sentiment is too bullish, or the policy at that point in time, okay, favored this, okay, continuation that will create, okay, an extension of the fifth wave. It makes sense? It is powerful. It's very powerful to understand why we have equality between the first and the fifth wave. Before I close this video, I have something here. I will read it to you very fast, okay, why there is equality between the first and the fifth wave. For a trend to continue or remain in place, it must be controlled or dominated by core buyers or sellers. Okay, we talk about it. The uptrend will remain in place if core bullish traders or investors have not yet divested. Okay, the same is true for core bearish traders in a downtrend. Okay, a typical bullish trend will start with a consolidation and a breakout. Similar pattern appears before a downtrend. However, This time, the consolidation phase is due to distribution. So at the beginning of a bearish trend, we do not have accumulation. We have what we call distribution. Distribution is the fact of selling a financial instrument gradually over time, because the smart money, this is why sometimes traders who are using moving averages have whipsaws. So a cycle is about to begin, but you will see that the price will oscillate, going ups and down, ups and down. Traders should pay attention to the market patterns, okay? This will allow them to detect what is taking place. Is this an accumulation? Accumulation, we will confirm the true accumulation with the fundamental, the market environment, and the market sentiment. We will also confirm a distribution with the fundamental, Google Finance, Yahoo Finance. Check, okay? Perform at least the minimum Google Asset test. Check the video about Google Asset test at Joe Trio YouTube channel. It's also our channel, okay? So let's continue with, okay, what I have here for traders. I have written here for traders, okay? Like a tree, okay, has its roots, which is the most important part, so has a trend. For a trend, okay, the root is represented by either accumulation plus breakout or distribution plus breakdown. However, the real roots are core buyers and seller. So what do I mean by that? So if we talk about the root of the trend, all right, though it's represented by the first and the second wave, the real root of a trend, we can call them the first buyers or the core buyers, okay? The real market participant, okay? The core market participant. All right? Now, after the first and the second wave, okay, we have other market participants that will join the first buyer. This is what we call the non-core market participant. So the non-core market participants are the public, the general money, or what they call the down money or the retail money, okay? Though other non-core market participants do add more fuel to the trend during the third wave, the true engine, okay, of the trend, all right, is the first buyers, the smart money, the hedge fund, the big institution. They are the core buyers. They are the first buyers. They are the engine, okay, of the trend, all right, so to speak, all right. Without doubt, they have decided, okay, they will decide, the core buyer will decide how the trend, okay, will start, and ultimately it will also influence how it continues or ends. So these first buyer, the activity, if they come out of the market so very early, the whole trend will collapse, which means the second wave will cancel the first wave. So they will remain in the trend during the third wave, okay, fourth wave, up to the end of the fifth wave. So they decide, in fact, the beginning of the trend, first wave, second wave, and they decide also how the trend will end, all right? They represent the root of the trend. They, as we can see, as explained to you at the beginning of the trend, their measuring stick is the amount of profit they have achieved during the first wave. They are using the same measuring stick during the third Elliott wave, but during the third Elliott wave, as that minimum target is hit, because other group of market participants have seen the trend, have joined the smart money now, that's why very often we see that the third Elliott wave will be extended, okay? As the market tries to repeat the first fractal pattern, I will not dwell on this one, okay? First wave, second wave, third wave, and the fourth wave, okay? After, I will explain that very briefly to you, okay? You see here? So we see here, I was telling you that for Home Depot, according to my wave count, this is the first wave from here to here, all right? From the 5-minute wave. So we have first wave, second wave, third wave, and then this pullback. Now, the smart money have achieved their profit in the third wave. They want to go now. They know that it's becoming a little bit expensive, and they don't like the public. They don't like the crowd. Okay, the market is becoming too volatile, and the smart money start coming out of the market. They know that, okay, they don't believe in the trend anymore. They know that it's now too expensive, and they want to go out before the general public. They are concerned, okay, that they may waste their profit, and they want to come out before it becomes too messy. They don't want to see a sharp correction, all right? But you can see that the general public, what the general public is doing, sometimes some traders, because most of the oscillator, the RSI, the stochastic will become overbought during the third Elliott wave. Majority of crazy traders or traders that do not understand the technical tool will be busy selling. So they are taking out, they say, oh, it's overbought, it's overbought, it's overbought, and they are taking out. But finally, after this pullback, they want to buy. So what they want to do, what do I mean by as the market try to repeat the first fractal pattern, the first fractal pattern is the first, second, and the third wave. Is what I meant by the first fractal pattern. So after the fourth wave, because there's a lot of traders couldn't catch or misread the price during the third wave, they were trading the indicators, all right? They want to start this move, 1, 2, 3. This is what I call the first fractal pattern. So now after the fourth wave, they want to achieve that. They want to repeat the same pattern, 1, 2, 3. But as they were trying to do that, the smart money that knew that the asset is now overbought or oversold in a downtrend, all right, because I'm using an uptrend financial instrument, the opposite is true in a downtrend, so the financial instrument will become oversold. At the end of the fifth wave in a downtrend, it will become overbought. At the end of the fifth wave, in an up move. But all when we are talking about overbought and oversold, we are talking about fundamental analysis and market environment and market sentiment, all right? Okay, so as the market, let's continue with my writing here, as the market try to repeat the first fractal pattern, first, second, and third wave after the fourth Elliott wave, the first buyers start divesting, leaving the market, causing a correction after the fifth wave. The first buyers achieve their profit during the third wave and start taking partial profit during the fourth wave. As the asset becomes expensive during the fifth wave, the first buyers will start selling their asset. It makes sense? It makes sense? So you can see that the late buyer want to continue the trend, but the asset becomes so expensive, is overbought, fundamentally and technically speaking, okay, then the smart money start divesting, coming out of the market. So because they are the root or the foundation of the whole trend, if these core buyers start coming out of the market after they have achieved the same profit during the first wave, that's why we have equality between the first and the fifth wave very often, not always, all right? Very often, but not always, all right? So as they know that, okay, this is the time after this pullback, the second target is again achieved, the minimum, using the measuring stick of the first wave. They done it here. It was exceeded during the third wave. Now they pull back again. They try to do it again. It's achieved. They want out right here if the asset is overbought. But now, the reason why the whole trend will fail will now come back to a correction, 1, 2, 3, is that the whole foundation of the building blocks of this trend is now kaput, which means the market participants that are holding the trend in place are now coming out of the market. That's why we see ABC correction, and this is the end of the Elliott wave cycle. By the way, before I close this video, I want to show you something here. You can see that my measuring stick for the first wave, talking about the dollar profit, I started from the lower part of this, my drawing here. And then you can see some traders took profit here. Doesn't mean that this financial instrument will start going up. All we can say is that we draw a warning line here and say that, okay, this is a resistance level, talking about a target or a conversion point. If the price goes above the 100 level and find a support, yes, game on. Is the market bullish? Is the fundamental solid? Is the asset not overbought? Okay, we give it a chance. All right, doesn't mean sell. If you receive a sell signal here, we will take it. But at this point in time, one should go to Google Finance or Yahoo Finance, okay, to validate, okay, the bearish sentiment at this resistance level. But what I want to tell you is that if I put my measuring stick, you see there was a console, you see all this candle here. Are you with me? Okay. Instead of putting it right here, okay, attention please, stock traders, instead of putting it right here, if I put it on top of this, you see, so suppose I did something like this, okay? So I put a horizontal line like this, you see all this candle here, doji, all right? If I put it here, you can see that, okay, we have at this point in time almost equality between the first wave and the fifth wave. See, if I consider my fifth wave, starting on my fifth wave right here, okay, talking about this candle like this, measuring the magnitude of my first wave, as I show you now, we have equality between the first and the fifth wave. Now you have seen it, you also understand it, because that's what we care about. The understanding allow traders, okay, to make excellent decisions and to filter out false, trade setup. I hope you have learned something from this video also about know why there is equality between the first and the fifth wave, okay, and we put into use, okay, to make excellent decisions. If you like this video, please give us the thumbs up. If you dislike it, please put your comment below. If you disagree with my wave count, put it below. And together, we'll make the YouTube, okay, a better place, a better education place for everybody. Until the next time, enjoy yourself and be very happy. We are the TSTW S008 traders. Speak to you soon.